Welcome to this explainer. Company law usually feels completely abstract. It's just dry, technical definitions buried deep inside the Companies Act. But today, we're going to translate all of that into the actual real-world life cycle of a business empire. To make it totally tangible, we're going to follow a single, hypothetical company's journey. So, if you've ever wondered how a tiny garage startup officially transforms into a massive globe-spanning corporation, you are in the exact right place. We're going to see exactly how the rules of the game change as a company levels up.
Here is our map of the corporate life cycle for today. We'll be covering who follows the Companies Act, starting up private and small, scaling up to public and listed, building empires with parents and subsidiaries, navigating liability and government control, and finally, tracking time and money. All right, Section 1. Who follows the Companies Act? Let's make our first stop on the map and figure out who is actually invited to this party. I want you to imagine starting your own tech venture. Let's call it Novatech. You've got a great idea, a couple of co-founders, and you're ready to incorporate. But a massive piece of legislation like the Companies Act can be, well, pretty intimidating. You might be wondering, does this entire rulebook apply to me? Does it literally apply to everyone equally? The short answer is absolutely yes. If you form a standard company, you follow this act. But what if you decide Novatech is going to disrupt the banking sector, like launching a modern fintech neobank? Or maybe you're getting into green electricity or insurance. Well, that's where the plot thickens. These specialized sectors actually have their own specific rulebooks. While the Companies Act still applies to them, if there's ever a clash between the rules, their special acts always take precedence. Basically, they get a customized set of rules because of how critical their industries are to the economy. Now, as your vision expands globally, you'll encounter a much broader legal term, body corporate. The crucial point here is that a body corporate is an umbrella term. It grabs hold of foreign companies incorporated outside the country, meaning they're recognized in the legal framework. But interestingly, it specifically leaves out local cooperative societies. Co-ops are just playing a completely different community-based game, so they have their own distinct laws.
Moving on to Section 2, starting up, private and small. Our hypothetical startup, Novatech, is ready to formalize, and the founders decide to start as a private entity to keep things tight. 200. That is your magic boundary. A standard private company strictly limits its membership to 200 people. You also intentionally restrict the right to easily transfer shares. Why? Because when you're just starting out, you want complete, absolute control over who your partners are. You definitely don't want strangers suddenly buying into your company without your approval. But here is a brilliant pro tip built right into the law. 200 people sounds like a lot, right? Until Novatech starts handing out stock options to attract top-tier engineers. But the law actually wants to encourage employee ownership. So if you give shares to your current employees, or if a former employee keeps their shares after they leave, they do not count towards your 200-person limit. Plus, if two people jointly hold a share, they only count as one member. It's a fantastic rule that lets you grow your team without being forced into a different corporate structure way too early.
And even within the private company world, there's a special, highly desirable tier, the small company. If you can keep your paid-up capital under 4 crore rupees and your turnover under 40 crore rupees, you unlock this small company status. And trust me, this isn't just a label, it's a golden ticket that exempts you from several heavy compliance burdens. It essentially lets you focus on building your actual product rather than drowning in paperwork.
Let's jump to Section 3, scaling up, public and listed. Fast forward a few years, Novatech is absolutely booming. They need massive funding to expand internationally, and it's time to scale up.
The big divide here is whether you're an unlisted company or a listed company. It's pretty straightforward. If your securities are actively traded on a recognized stock exchange, letting the general public buy and sell your stock by the minute, you are a listed company. And with that public access comes an incredibly intense level of regulatory scrutiny and transparency. If you aren't on an exchange, you're unlisted. But wait, there is a massive plot twist here for corporate strategy. Imagine Novatech needs money, so they issue debt securities privately to some massive institutional investors, and those specific debt instruments happen to get listed. Do they suddenly face all the heavy, exhausting compliance of a fully listed company? No. The law says if you are a public or private company that has only listed non-convertible debt on a private placement basis, you are not legally considered a listed company. It is a super clever way to raise serious capital without triggering the ultimate regulatory headache.
Section 4, building empires, parent and subsidiary. Okay, so now you have capital and scale. It's time to guide your company into the empire building phase.
The first step in empire building is taking a strategic stake, acquiring at least 20% of another company's total voting power. Say Novatech buys a chunk of a smaller AI startup, establishes what the law calls significant influence. When you hit that 20% mark, the target becomes your associate company. You don't own them completely, but you have a very heavy hand at their decision-making table. But when you want total control, you push past that halfway point. If Novatech crosses the 50% threshold of total voting power, or if they gain the power to control the majority of the board of directors, that target company legally transforms into a full-blown subsidiary. And congratulations, you are now officially a holding company. You're sitting at the top of your very own corporate empire. We do have to highlight a crucial real-world exception here, though. What if a major investment bank is holding 55% of a company's shares simply in trust for a wealthy client? Are they suddenly a holding company managing a tech subsidiary? Not at all. The law clarifies that shares held in a fiduciary capacity, meaning they're just held in trust for someone else, do not count towards determining an associate or subsidiary relationship. Actual functional business control is what matters, not just administrative holding.
Section 5, Liability and Government Control. As your empire expands, risk naturally increases. So let's shift our focus to what happens if things go wrong. Most standard businesses are limited by shares, but there's a fascinating alternative, the company limited by guarantee. Think of your local community sports club or a charity organization. The process is simple but deeply protective. Step 1, members legally promise a specific amount in the company's memorandum. Step 2, and this is the magic part, those members only ever have to actually pay that promised amount if the company goes bankrupt and is winding up. They're completely off the hook for day-to-day operational debts until the very bitter end.
Now let's talk about the ultimate heavyweight player, the government. If the central government, a state government, or a combination of both steps in and grabs at least 51% of a company's paid-up share capital, that entity is officially categorized as a government company. And if that government company goes on to create a subsidiary, well, that subsidiary is a government company too. Once the state holds the majority, the entire nature and oversight of the organization shifts. Finally, Section 6, Tracking Time and Money. We're nearing the end of our life cycle map. Whether you're a startup or a government giant, you've got to keep score. Every company operates on a financial year, generally ending on March 31st. But here is a massive structural pro tip for founders. If you incorporate your business between April 1st and December 31st, your first financial year ends on the upcoming March 31st. But if you strategically incorporate on January 1st or later, your first financial year legally extends all the way to March 31st of the following year. That trick gives a brand new company up to 15 months of breathing room before they have to close out their very first official financial year. When that deadline finally does hit, you have to show your work. Every standard company must prepare a comprehensive financial statement. And this isn't just one quick document. It includes the balance sheet showing your overall health, the profit and loss account showing if you actually made money, the all-important cash flow statement, any changes in equity, and detailed explanatory notes to provide context to the raw numbers.
But remember that golden ticket we talked about earlier? This brilliantly illustrates why being a small company is so incredibly valuable. Preparing a cash flow statement is notoriously complex and expensive. So the law steps in and says, if you are a one-person company, a small company, a dormant company, or a recognized private startup, you get a break. You are legally allowed to completely exclude the cash flow statement from your end-of-year reporting. It's a huge operational relief that helps keep early-stage businesses agile.
We have just traveled through the entire legal map of a business's life. We've seen how keeping an eye on the technical details like employee shares, private debt, and even your incorporation date can actually shape your real-world strategy and give you a massive edge. So I'll leave you with this. From a highly controlled solo startup to a sprawling corporate empire dominating the market through subsidiaries, the framework is there waiting for you. What kind of business will you build with these rules? Thanks for exploring this with me today, and I really encourage you to keep questioning how the rules of the game can work to your advantage.